SynBioBeta Live. Today we have a new format. We have two shows in one. So for the first 45 minutes, we're going to be talking about investment and investing through times of change. And in the second part of the show, in about 45 minutes, we're going to be talking all about neuroscience, brain-computer interfaces, and happy chemistry. And we're going to start that session, not right now, but we're going to start that session with the stress test and asking how everybody's feeling today. So we're not going to dive into that right yet. But before we do that, I just want to thank particularly some of our sponsors at SynBioBeta, because we're starting to get these shows sponsored. And in particular, I'd like to thank Twist Bioscience, who's going to be sponsoring a very special show that we're going to be doing on Friday, all about antibodies. Yes, we have Aaron Sato from Twist, and we have Jim Crow from Vanderbilt, Jake Glanville from Distributed Bio, and a whole number of other. We have 11 total companies talking about COVID-19 antibodies. So it is the antibody show. Come back here 8 a.m. Friday to learn all about that. And if you're an antibody company and we haven't reached out to you or we don't know what you're doing, then type it in the chat box, so you can email us at info@synbiobeta.com. As usual, this is a live webinar, and we would like to ask you to type your questions into the Q&A box. Don't type your questions into the chat, but if you do type them into the Q&A box, other people will ask and answer your questions, and they'll also like your questions. And that means that the best questions rise to the top, and you can also raise your hand. And if you raise your hand, you get to ask our prestigious panelists of investors their question in real time, which is always a lot of fun. So we're going to be diving in, and in particular, we would like to welcome our special guests, who are this prestigious investor panel. We're also going to be live tweeting this event with the hashtag SynBioBeta Live. And so I'd just like to take 30 seconds before we start for you to open your Twitter browser and type in that you are watching SynBioBeta Live, investing through times of change and neurotech. And we want to try to get the hashtag SynBioBeta Live trending amongst all these science geeks. So if you could just take 30 seconds of your busy day to do that, we'd appreciate it. It gets more people knowing about SynBioBeta, knowing about the exciting work that all of you are doing, and getting excited about the future, both of investment and of investing through times of change, and about neuroscience. Today, we have some news that's come out this week. We had some exciting news about synthetic genomics SGI DNA renamed to Codex DNA. The company raised 25 million Series A in September. And if you're familiar with Dan Gibson and the Gibson Assembly, Dan is still working feverishly at Codex DNA, making things like vaccines and long strands of DNA. So very exciting there. And just recently, Zymergen announced a brand new material called Hyalene. If you check out my Forbes column and then you're a regular reader there, you will be able to read a profile all about Hyalene and how Zymergen's doing some very exciting things at the intersection of materials and synthetic biology. So as I said, today's first panel is all around synthetic biology investment. And as biotech founders attempt to inoculate their teams against the economic and social upheaval of SARS-CoV-2, what is the investment community doing? And as the world turns attention towards biotech companies to solve this pandemic, what does the synthetic biology industry represent? And does it represent an even richer opportunity? Or will the funding frenzy that we've seen over the last few years be cooling off? That's one of the questions that I'll be asking our prestigious panelists today. I'm joined by my good friend, Matt Ocko, managing partner and co-founder of Data Collective, DCVC. Data Collective, I'm actually an operating partner at Data Collective. We've invested in a number of companies in the synthetic biology. And all of these people are my good friends, of course. Ursheet Parikh, who is a partner at Mayfield. Mayfield was one of the very early investors in biotech, funding companies like Genentech, more recently funding companies like Mammoth Biosciences, who we've covered on SynBioBeta Live, talking about their diagnostics. Jenny Rooke is the founder of Genoa Ventures. You will probably know Genoa Ventures if you're a familiar attendee at SynBioBeta, because for the last couple of years, they have sponsored the cappuccino cards, which have been one of the most popular features to keep all of you founders and investors going during the 3-day frenzy that is SynBioBeta. And lastly, but not least, Jürgen Eckhardt, who is the head of Leaps by Bayer in Germany. And Leaps is the investment arm of the pharmaceutical company and ag company Bayer. And I was recently in Berlin just before this terrible lockdown situation in January, meeting with Jürgen and the Bayer team. So very excited. Welcome all of you to SynBioBeta Live.
Glad to be here. Thanks for putting
Great.
it together.
Absolutely. So I want to start with Matt Ocko, because Matt, you and I discussed this panel and what we were going to talk about, and you said that you think that the timelines for investment right now are broken, and you think that they're broken because of this 10-year fund cycle. Can you just go into that in a little bit more depth? What's broken and how could it be fixed?
Well, I'll try to be as concise as possible, because this is an immense topic. Look, we're all of us who have capital from other folks are limited partners who contribute to the pools of dollars that VCs then invest in the kind of determined cutting edge entrepreneurs who are today across all of our portfolios driving towards cures and tests for COVID-19 are smart, thoughtful people. We're grateful for their capital. We're privileged to be able to invest. That being said, all systems have emergent properties, some good, some bad. And one of the emergent properties over the last, call it 20 to 25 years in venture capital and in anything that touches large pools of dollars in general is short-termism. A lot of people smarter than me have written about it. It's this quarter-to-quarter focus that you see in companies that have to report to Wall Street. It's the unspoken pressure for folks to invest in dodgy fruit delivery companies in foreign domiciles with 9 sets of books and gray market bank loans for a quick return. And the current crisis, I think, exemplifies that we haven't done enough long-term investing. We haven't done enough long-term investing as a country in our infrastructure, especially in healthcare. But we also haven't given a lot of the innovative startups that, especially in biotech and SynBio and computational biology, become young public companies that need additional nurturing. We haven't given them long enough runways to become things like a Genentech or an Illumina. And Jenny has done across her career some particularly pioneering stuff. And I can imagine that if she had her druthers, she, like us, wouldn't have minded another 5 years that those companies could stay private inside the scope of a single fund, or receive better long-term treatment from stronger long-term holders as young public companies.
So let me bring Jenny in there. Jenny, have you invested in any of these fruit cart companies that Matt speaks of? And maybe you could give us a little bit of background, because you were, before starting Genoa Ventures, you were at the Gates Foundation, and of course Bill Gates is one of the giants in long-term thinking. We've seen a lot of the amazing work that he's done in funding vaccine scale-up facilities right now, placing big bets. Can you give us a little bit of your perspective on the long term?
Sure, I think it's a very exciting topic, and the opportunity to bring the same creativity and innovation to thinking about capital formation and how different kinds of capital is better suited to different kinds of innovation is an important part of the puzzle. I was actually in venture before I went to the Gates Foundation, and for me it was an experiment in doing exactly what Matt is describing, which is thinking about how my investment decisions at the Gates Foundation were impacted by changing my time horizon from 10-year fund cycles to 30, 40, 50-year foundation mission cycles. So I would say there is a lot of room for thinking creatively about this. Those are just 2 examples. We have many different flavors of capital. We've got private equity, we've got grants, we've got government. So I don't think it's that venture is broken. I came back to venture because I really believe in the toolkit there for driving innovation and supporting great companies that are going to transform industries. But I believe it's not the only flavor of capital. And part of the exciting thing about being a venture investor is helping our companies think about accessing the right kind of capital at each stage that has appropriate expectations for timeline, risk, et cetera.
Jenny, can you give a specific example of how something clicked in your mind in terms of the change from shorter term 10 years to 30, 40 years?
Sure. I think, for example, at the Gates Foundation, we did try to be quite rigorous about choosing where to put the next dollar, just like we would be as fund managers. But when we're thinking about returns profiles, there was room to have a portfolio, if you will, of interventions at the foundation that included near-term impact, like delivering bed nets, right? That changes someone's life that day. And then 30, 40-year timelines, like developing a malaria vaccine, but realizing that we had to start with better mouse models for the immune system and being able to invest in the tools that would enable the biology, that would enable eventually the clinical development of new interventions. And that's a very long-term prospect.
Great, excellent. Yeah, can you give us a little bit of a flavor of Leaps by Bayer? Part of the name Leaps is that it's a giant leap that you're looking for entrepreneurs to take. And if you could just give us an example. I know there are 10 leaps. People could go on the Leaps by Bayer website and understand what those 10 leaps are. They're all pretty phenomenal, groundbreaking shifts for humanity if they could be solved. If you could just give us an example of a couple of them and talk about the kind of entrepreneurs that you back right now and that you're looking to back in the future for these leaps, and then help us understand, given that perspective, your timeline horizon in your investments.
Sure. Thank you very much, John. Yeah, so Leaps by Bayer is sort of our strategic investment arm of Bayer. Bayer, a large conglomerate with pharma, consumer health, and a crop science division, and they obviously run their businesses and they do their own BD&L activities. But Leaps is really outside of these divisions, and our mandate is really to invest in sort of the long-term potential breakthrough disruptive technologies, that are early stage, probably too early stage for the divisions to embrace at that point in time.
I think we've got some audio issues, but let's just go to Ursheet right now. We can come back to Jürgen once the line under the Atlantic gets repaired. Ursheet, you think a lot about marketplaces. We've talked a lot about it, marketplaces for diagnostics. Indeed, next Friday, we're going to be having another SynBioBeta Live that you and your colleagues are going to be on, talking very specifically about diagnostics marketplaces and how we can create those. So could you give us a sense of your timelines for Horizon and what you think is broken about the venture capital model?
I actually end up coming from the other end of the spectrum a lot of my life in startups, where the real timelines you think of is 18 to 24 months, because that's generally how quickly you're raising funds. And then the corporate life, where it would be 3 to 5 year timelines to get to something to $1 billion in revenue. If you're starting something new inside a large company, at least in the Bay Area, it's pretty hard to sort of go ahead and get the 7 to 10 year funding. So I actually find the model that we are operating in generally fine. But it's also because the model that we have is out of one fund. So the same fund invests in consumer, enterprise, and engineering biology. And so we find that the ability to have a 10-year fund with the option to extend by 15 years pretty much creates a selection, and so it almost brings constraints that help us focus on the kind of deals that we end up doing. And this is not, as the fund has been for a long time, but I'll give an example, right? So fundamentally what happens for us is we need to see a path from from when we invest to a 7 to 8 year path for the company to get to 100+ million in revenues at high operating margins. Now, before my time at Mayfield, when the clean tech boom was on, Mayfield was one of the few firms that actually did do very well in clean tech investing. But it was focused like this that then forced the firm back then, and even today what we do is to not just think about the technology, but also think about the business model. And so our largest return in clean tech was SolarCity. And where they had innovated on was not, in fact, they actually over-pivoted and innovated primarily on access, distribution, and the business model of this new emerging technology. Then and there I think sort of brings an inherent bias that is there in sort of a very technical ecosystem, which I think the venture ecosystem is. It's less finance and more technical. where there is a tendency to want to solve the hardest problems. They're often science or engineering problems. But to sort of really build lasting companies, more often than not, you see that they do need to innovate across the full business building spectrum. And very often you can sort of create big barriers to entry if you have a different sort of business operating model or just a business model in general. And if you look at the clean tech era, right, I think a lot of the people in venture didn't truly understand that. And so, there's very few firms that actually backed Elon Musk and, backed people who were more unlike him and seemed more conformant. And, I think the only thing I can say at Mayfield is we were not idiotic enough to say no to him twice, but I totally empathize the point that I think Matt and Jenny were also saying, right, which is you have this 10+5 model, but that's clearly not enough for a certain class of problems. So for me, I look at it as a personal challenge right now that I do think that adapting the world to the new climate reality is probably the single biggest entrepreneurial opportunity of all time. And because I sit in a fund which is in this 10+5 cycle, and every dollar that's kind of going in engineering biology has to prove that it's as good as a dollar going into consumer tech or enterprise tech, it forces me to sort of think about how we can make some of these things happen sooner, which at times means that I can't invest in things which have much longer time horizon than that. But then sort of, as I said, the constraint brings the focus on, okay, how are we going to go? And generally, I'm an impatient guy by nature, so hopefully that helps me.
Excellent, thank you. And Ursheet, just to clarify, you said you got the chance to invest in Elon Musk, and you did the second time, or you
yeah. So SolarCity, Mayfield, like a lot of other VC firms, I think barring DFJ, who did invest in Tesla, most VCs actually did not invest in Tesla. And then SolarCity was the other company that we had founded after that. We eventually landed up in Tesla, and my partner Naveen actually led one of their rounds. And it was actually right in the recession. You'd be shocked, but it's probably public record by now. But the company had, that round had happened in a valuation of under $300 million when their revenue was well over $100 million at that point in time. So wow. It was something that happened in really 08, 09, something, or 09, 010, something like that.
I think one of our success stories in the synthetic biology industry is Twist Bioscience, which IPO'd probably about 18 months ago now. And if you speak to Emily about how many no's she got before she got a yes, I think it's 80. So it really is for all those entrepreneurs who are listening, it's worth persevering and pushing forward. Yeah, we fixed the line. I'm not sure whether the breakage was underneath the Atlantic or through the mountains in Switzerland, but if you want to just jump back in where you were explaining about some of the exciting leaps that Leaps by Bayer is looking to fund entrepreneurs in, and give us a perspective of your timeline.
Sure. Yeah, so I guess the first part of what I was talking, people could hear, so I'm not going to repeat that. So as I said, we are strategic investors, right? We invest in the very early stages, breakthrough technologies, and we realize that this may take a very long time until we get to success. And for us, success really is getting, cures into man, or getting products to market, right? That is sort of our end game here. We are obviously not acting like a financial investor who needs to seek a financial exit rather earlier than later. And from that point of view, I think Matt was raising a very good point. While we do happily co-invest together with a number of VCs around the world, we do realize there is not a full alignment of interests, because they have their 10-year funds, right? They need to get to an exit over a reasonable time frame, which is normally sort of 4 or 5 years, and then they are pushing towards an exit, which is not always what we want, right? Because we really are in it to get a product into humans, get a product on the market, right? So there is some disalignment there, or can be some disalignment and discussions and frictions, I guess, along that process. So I would very much welcome, obviously, if VCs would have longer term funds, which would allow them to invest for the long run, as we do, right? So give you a few examples, or give you maybe one example for starters. What what things are that excite us. So we defined one of the leaps is really to reduce lost tissue function, right? This is a very broad area. Most or many chronic diseases are really characterized by loss of tissue function, such as, take a myocardial infarct patient, who has a scar tissue in his heart muscle. With all the therapy available today, you will not get that tissue away, get that scar tissue away, and therefore will never be able to restore full function of that heart, right? If we are able to replace that scar tissue with beating heart muscle cells, then we can talk about a real cure. And that is, for example, one of the indications that one of our investments in 2016 was pursuing. It's a company called BlueRock, which we have created in 2016. And even though it's still early days, we are still preclinical. Actually, Bayer Pharma then has decided last year to acquire that company, and they really want to use that as a nucleus for our own cell and gene therapy approach within Bayer, which is a great outcome and came earlier than was anticipated, really. Because as I said, it's still early days, but that's sort of the things that excite us, just to give you one example.
Great, excellent. And I do encourage our listeners and viewers to go onto the Leaps by Bayer website and look at the other leaps that are being funded by Bayer right now. It's very exciting. Matt, I want to turn back to the economy and talk about investing through downturns. What's different about this downturn from the previous ones?
Well, to kind of follow on from the previous discussion, what Ursheet was talking about, having generated a net rate of return of over 100% in and out of every recession and downturn across getting close to 30 years in aggregate as a team, the constraints of the venture model in the face of economic dislocation generally haven't bothered us, and they haven't bothered our disruptive entrepreneurs, whether it's folks like Zymergen or Pivot, who are substantially replacing synthetic fertilizer across millions of crops, even this year in the midst of the lockdown. What's different about this one is I think that the economic, how can I put it, stasis, the freeze, if you will, is across a greater number of industries in a greater number of countries than has been observed by anybody in our lifetime. And for the kind of companies that I think everybody on this panel likes to invest in, which again are companies that make things, companies that do things in labs or manufacture things. The difficulty of getting folks to execute those jobs safely is harder. There are technologies like our company Stratios, which provides the equivalent of a multi-100,000 square foot wet lab and pharmaceutical chemistry platform in a fully roboticized environment, so scientists can run major pharmaceutical programs from in front of an abandoned Starbucks. Those things help, but we're going to all need a lot more of that in kind of a pandemic world to enable people to get complex, difficult classes of innovation done. And I think, one, we're going to see great investment opportunities there. I imagine my fellow panelists probably have things up their sleeve in that area besides Zoom and Slack. But we also need them urgently. So kind of two sides of the same coin of problem and opportunity.
Great, thank you. And I need to explain to my viewers that I have my bowl of breakfast sitting in front of me, taunting me, and I had some AV issues this morning. I wasn't able to get to it, and it's a 2-hour-long show today. So please excuse me while I eat my breakfast while I'm talking to my panelists. I just felt I need to disclose that fact. But as we're diving in here, I also want to remind everybody that this is a live Q&A, and you can type your Q&A into the box. We'll upvote the best ones. I've also seen we've got an amazing star-studded attendee list. So if you find that you've been mysteriously promoted to a panelist, it's because I've seen that you're watching us, and I'd love to know what you think. So I'm not going to call on you without knowing that you've got a question to ask. So if you are one of those star-studded celebrities that I've called on, please type your question. Please just raise your hand, and I will dial you into the conversation shortly when we get to the Q&A. We have a lot of great Q&A going on, so type your question in the box if you have one. Jenny, I want to ask you a question about the pre-revenue, pre-profitability status of the synthetic biology industry as a whole. Do you think that this coming recession is going to see a crash in the industry with a lot of these pre-revenue companies going out of business? Or do you think this is a golden opportunity for synthetic biology to shine, given how much value it can provide both to the COVID-19 outbreak and for sustainable manufacturing and bio supply chains? What's your perspective? And do you think we're going to see a reduction in the number of startups, or do you think we're going to see a flourishing of and an ushering in of the century of biology?
Can I say yes, both?
You can.
Yeah. I think I've even said from the SynBioBeta stage that synthetic biology is a discipline, it's a movement, it's a change, it's a tide, but it's not actually an industry. It's not a business model. It's not a vertical, right? And so to think about your question, we could spend the rest of the time on it. We'd have to think about the different types of innovative businesses that are working within the field of synthetic biology and recognize that some of them, as you described, are bio-based and look more like biotech and are for quite some time. Others have a model that is more like products and services, and so they were on a ramp to getting to or increasing revenue. And I think we've seen that downturns treat those different types of companies differently. And certainly we're treating our portfolio companies that fall into those two buckets differently. In all cases, I think one of the benefits of this particular downturn is that it's a moment where there's ample information and frameworks for thinking about how to get through it, because we have seen it before. It's not our first rodeo. And the general guidance is, make sure you can get to the next rock, which we don't know how long this lasts, but assume it'll be at least 18, 24 months. And so make sure you can get to there, because that's probably your next financing event. And so for synthetic biology-based companies that are revenue generating, who have those kinds of business models, they're taking the advice and the playbooks around reducing burn, increasing revenues, really focusing on high-value customers and partners. For our pre-revenue companies that look more like biotech, we weren't expecting revenues anytime soon anyway, but the overall guidance is still the same, which is you've got to get to that next financeable milestone. And it might take longer to do that. If you're in clinical trials, clinical trial timelines have just extended. It's hard to get patients into clinics to get the next data point. And so the guidance there, again, is what is it going to take to get to the milestone that you were hoping to hit in 12 months, and maybe in 24 months. So I think the good news is that companies that focus on business fundamentals, regardless of model or industry or sector like synthetic biology, can emerge stronger. But that's why I think this is a yes and answer, that there are plenty that can't get there, that'll be shaken to their fundamentals, and we will see a winnowing out, unfortunately, of many interesting teams and technologies who just hadn't really gotten there on the business, to Ursheet's former point.
But of course, we can also see that starting companies in a recession is an amazing time to do that, given the talent that falls out when these companies go out of business. Looking at Airbnb, looking at Uber, looking at the birth of the ecosystem that we had from the last recession. So That's a very sobering point, Jenny, but also I agree that it's a yes and. Ursheet, any perspective, any advice that you're giving your portfolio companies right now? Is it the same as Jenny said?
So, in 2001, 2002, and 2008, 2009, I actually started companies. So I've lived through the last two recessions as an entrepreneur, not as an investor, as Jenny and Matt have. So I agree with the point that you make, which is that it's a great time to sort of start a company. But this is also probably one of the most sort of challenging times if you already have started a company. So first, I think if we see the nature of economic cycles, no company goes on to become a true, resilient, lasting, high impact company for the long term if it doesn't live through one of these sort of difficult times. And then sort of so what are some of the top lessons that I have out of these difficult times? If you are truly the best in your category, and the best is not just on buzz, but it is on raw execution, and execution on all levels, how you are sort of running the communication with the outside world, how are you building the product, how are you sort of being focused on your users, how are you focused on the business model, then there is money for the company in any market. The valuation functions differ. Often, I've heard some entrepreneurs kind of complain about how, venture capital is beginning to feel like vulture capital, and there's a power dynamic that is shifting. And so I think those conversations actually don't help and don't form the basis of any long-term relationships. Fundamentally, what happens is once you enter a recession and somebody has invested in your company, they are aligned with you to get the company to the next milestone and get the company financed. What happens is that the bar for follow-on financing goes up. So, I've been in a position to partner with some amazing entrepreneurs to just close a Series A last week. The founders here have combined, so the two of the three founders have created companies worth more than $5 billion already. In any market, they would have gone for a round of financing and they would have probably diluted 20, 25%. Right? As we were going through the past month, a lot of the legitimate question, and by the way, this was happening, they were raising their funds while Mayfield itself was raising our own funds that we closed a few weeks ago. And so part of that exercise was what is going to be required to get to that credible next phase and how much capital is going to be needed. And normally they would have basically raised this round and then gone and raised another round in 18 months. And the conversation was, well, if you are not going to be in a certain post-clinical milestone where somebody can sort of justify, that this is going to be the basis for a big company, it would basically be setting the company up for an exit or an investor who would really fund it for a short-term view of an acquisition. So if we are really in this company to build it for the long haul, in this case, instead of raising, $10 to $12 million, we need to find a syndicate that can come together to fund this company for $25 million. And that meant that these founders who did have the track record sort of said, you know what, that's probably the right thing to do. We are not valued that much more than what we would have been otherwise. And so it's going to be, a 60% dilution round to sort of go ahead and do that, because that is sort of the right thing to do. So in some sense, what happens is that I think we're all sort of better set up, right? Investors have to write a bigger check than they would have because the size of the raise increase the valuation. But the company is better set up to sort of get further along. But it cannot happen if the conversation between sort of entrepreneurs and VCs starts becoming, antagonistic. I'll give a perspective, right? When I did my Series A in the company I co-founded in the tech space called Store Simple in 2009, I had a co-founder who was a repeat entrepreneur. I had just built a business from 0 to 100 million a quarter for Cisco, and we were starting this company a month after General Motors became Government Motors, 11 years ago. And we went for a fundraise, and our Series A was a 70% dilution fundraise, right? We basically had 8 million on 8.5 pre, and it was going to be one of the deep tech companies. It became one of the largest first-gen cloud infra exits, but within 4 years. But we had 50% of the company roughly given up for the independent board member and the Series A investors, and another 20+% of the company set aside as employee option pool. Now, so there's this pros and cons out, but the key was investors would ask me, why not start this company at, with 5 million, right? Series Bs are happening at 10 and 12 pre, you're going to be at 16 post after this. And my point was that, well, I don't want to kind of get this company funded for an air pocket or a dead zone. I'd rather not start it than sort of go ahead and do that. So I do think that the opportunity ends up being the sooner entrepreneurs and investors can align and have a conversation and then develop deep partnerships, then it sort of sets up for a great time to build an amazing set of companies. And, you know, most VC funds are investing other people's money. And so, you know, it's at a certain semblance, there is a deal, you know, one GP can't take to a partnership, a deal that is going to be like 2 times the value of where the market is. So somehow there is a market price that sort of emerges in a process. But anyway, so that I'll just kind of pause it that. I could go on this thing for a while, but I do think that this is going to be a great time to build products, you know, and we'll see some amazing companies come out of this. And you know, I think synthetic biology and technologies for improving human and planetary health will basically come out of this exceptionally strong.
Great
John,
insight.
To that,
yeah, go ahead, Matt.
To that point, I was an entrepreneur long enough ago. I think Ursheet may have even forgotten it. But I actually was building companies in the 80s and the 90s. And one of the things that's very and painfully true is timing and luck govern these outcomes, starting from the kind of valuation mechanics that Ursheet was talking about, and that dance between investors and entrepreneurs, and ultimately the exit more than we would like. When I was a teenager, some friends of mine and I invented a fair number of things that still predominate in email, and built that in the 1980s to 1 million actual customers worldwide. And the value that we got from that thing versus, say, giving it away for free in 1997 and selling it to Yahoo was painfully, let's just say the ratio was painfully humiliating on exit. Likewise, in this moment, if you're doing autonomous cars and you need hundreds of people in the same room soldering, you know, lidars together, you may be in a situation closer to what Ursheet described, where people's anxiety about the risks attendant to heavy engineering in a pandemic mean you're going to have to ask for more money and probably at a lower valuation than would excite you. By contrast, I mean, one of our companies that just happened to be in the right place at the right time at the intersection of computational and synthetic biology just got a $100 million term sheet for a substantial up round, because they're viewed as being literally in the right place at the right time. To Jenny's point about trials, there's a company not in our, actually a set of companies not in our portfolio, plethora of them that are focused on bringing trials in a safe way to closer to people's homes, or even without actual physical interaction with people. And then there is one of our companies called Unlearn that's closing the material up round, because they make it possible to have completely synthetic control arms, even for very difficult trials like Alzheimer's. So, and by the way, this is not meant to be an advertisement for our portfolio. Everybody will suffer some measure of pain if they do difficult, innovative stuff, because some things will have great timing, and some things you're going to be completely a supplicant. Having been an entrepreneur, I always try to be immensely sympathetic to this luck and timing factor. And by the way, I think it's incumbent on VCs that want the kind of tenure that we've had and that Mayfield certainly enjoyed, not to be predatory. If you treat this as an opportunity to reprice stuff because you're in a bad mood, that is not an acceptable thing from a reputation or quite frankly from a moral standpoint.
Yeah, you know what? I couldn't agree this on this more. We've seen so much, I would say, just shitty behavior, like outright. I wouldn't say immoral, even illegal behavior. We've seen people, sign term sheets and then, choose not term sheets, sign definitive agreements and then choose to not follow through on the funding round and then ask for a way again and stuff like that. The only thing that I have seen from my time in the Valley, especially through the last recessions, most of those investors are not in business right now. So, I think the system does a good job of, because the reputation, right, credibility is everything. In the end, venture, if you really think about it, is the ultimate commodity business of money. And in the end, right, when an investor is basically sort of investing or partnering with an entrepreneur, it is about really saying, every once in a while you find an amazing entrepreneur doesn't get enough investor, but I think what is different this iteration around compared to previous things is there's genuinely a lot more capital in the environment, and entrepreneurs will have the ability to pick sort of the right partners, and in many ways investors have to prove why their money is greener than other money that the entrepreneur could be getting, and so track record, credibility, reputation is everything. And I think the firms that did sort of do, and actually, by the way, it's not just firms; it's even corporate investors.
Right.
That have asked. I mean, so yeah, I mean, in the end, then what happens is having great syndicate partners that can support these companies on the inside.
Ursheet, I want to bring Jürgen in a second just to talk about the shifting power dynamics with investors and entrepreneurs. But I do want to remind everybody, if you want to come on live, please raise your hand. John Nichols, if you want to turn on your video and ask your question live, and the same for Natalie Ma, that would be great. And if you've got a question, type it into the Q&A box. The best questions rise to the top, and then put your hand up and turn on your video, and you can come and ask our panelists live. We have about 10 more minutes. So I want to make sure that we get to some of these questions as well. And we talked about investing through applications, and in about 15 minutes, we're going to be bringing on a whole panelist talking about neurotech investments and neurotech applications. We have Matt Angle, who's the CEO of Paradromics, talking about interesting applications. This is a brain-computer interface chip that Paradromics has developed for curing many paraplegics and other things. So we're going to be talking a lot about brain neuroscience, and that's on the top of the hour. Also, I want to remind everybody that a lot of these SynBioBeta Lives are sponsored. We've got a sponsorship from Twist Bioscience on a antibodies show on Friday. And if you are interested in sponsoring a critical conversation right now, we're trying to find a balance between art and commerce. So somewhere in the middle is these conversations, but we also are looking for sponsor conversations, and we'd love to have your input on that. So you can email info@synbiobeta.com to get input there, and we'd love to have a conversation with you. So yeah, can you just follow on from that and maybe talk about the shifting power dynamics that Ursheet and Matt talked about, what you're seeing? I think probably the Germans and the Swiss and the Europeans slightly more polite, less cutthroat than the Silicon Valley VCs. Can you talk about the shifting power dynamics that you're seeing?
Sure. So first of all, I think of course, we are probably going through a recession, maybe a larger recession. But overall, I think for this industry, for the synthetic biology industry and for the biotech industry at large, I'm actually pretty optimistic. Sure, fundraising may be a little harder than it used to be 6 months ago. Valuations may be a little lower, but hopefully not dramatically lower. And certainly probably still up from, a few years back. So yeah, things may get a little harder, but overall, I'm really very positive and bullish about this industry, because I think at the core, this industry is delivering value, right? We have new scientific insights and breakthroughs every day in thousands of labs around the world, right? And that scientific advancement and new insights is not going to stop, even in a recession, right? And that's really the core of this industry, right? That is what ultimately leads to all these new companies. That's why I'm really super bullish, really, and optimistic about the future, even though, the financial markets and environments may be a little harder in the months or years to come. I still think money will be available to good ideas and will get funded. And, certainly from my vantage point as Leaps, we are looking at this through strategic eyes. We are investing for the long run. Actually, science for a better life is Bayer's tagline. That's what gets us excited, and we will continue to invest in that, no matter where and when. And we are certainly not known for sort of exploiting difficult situations of founders, and will honor certainly the progress and the value that we see.
Excellent. Thank you, Jürgen. John Nichols, go ahead and ask your question live. John's the CEO of Codexis. And if you could just tell everybody what Codexis does, John.
Thanks very much. Really great panel discussion so far. So Codexis is a leading protein engineering company. We were started up in 2002. We're public now, and we're discovering and commercializing novel protein molecules in a growing list of applications. So my question, similar, we're looking at this industry with strategic eyes and potentially partnering and bringing some of our capital in. This panel has a lot more experience, like Jenny said, not the first rodeo. How do you see company management and boards shifting already in these early days of the COVID realities in terms of the way they're thinking about their businesses, their access to capital? And can you segment amongst those companies? Are there different segments of company behaviors already? And how do you see that unfolding as we get into months 2, 4, and 6? Thanks for taking the question.
Great, thanks, John. Who wants to take that?
I mean, I could take a first, but go ahead. Matt, you want to go?
Yeah, go ahead, Ursheet, and then we'll go to Matt.
Yeah.
So I think, the segmentation really ends up being sort of on the stage of the company. I think if a company is not in revenue, I think then the question is, how is something like this impacting the development path plan process? My advice to most of the companies is to find a way to have 2 years of runway. And the logic of this more or less kind of goes as follows. The best wisdom saying that, this could go away in 3 to 6 months. It could be 18 months. But generally what has happened is it's changed the way people are working. And so when it comes to larger rounds of follow-on investments, we are going to have sort of this bandwidth constraint on doing deals in the near term as this thing kind of clears out. And not a lot, and a lot of the later stage capital has thinned out or has disappeared. And so if the company doesn't want to sort of be in a duress position, it probably becomes better to sort of match the expense sort of trajectory, freeze hiring, cut sort of discretionary spend if the need be for lows or things like that to sort of have 2 years of capital. That can be a little bit more challenging in companies that are in revenue and actually have the revenue itself that is funding the business, because it's generally pretty hard for the forecasting to happen. For most companies that are in revenue, so there's 2 buckets, right? There's clearly a set of companies and several that I'm kind of working with, right? Scanwell Health, Endpoint, Mammoth, Cuventus, right? These are all sort of seeing significant acceleration on their business because they are at the core of sort of the solution to the COVID problem. Then there's a set of companies, which are in other areas where, for example, as Jenny mentioned, since clinical trials are paused, it's going to go ahead and delay this thing. So you have to kind of adapt. And then there's companies that are already with products in market that are powering life science research and things like that. So there, then you really end up having to sort of figure out, is COVID going to hurt or harm? So the first thing that's happening is all companies are seeing a significant increase in activity this month. By that, what I mean is, if you are in revenue, there's more and more customers that want to talk to your sales teams. It's part of it is because maybe the interest is real and your solution is part of this COVID response, or it is because your customers have more time. They are at home and so they're more available to your sales teams, or your sales teams are worried that they may not have a job and they're trying to sort of justify. I mean, there's a lot of this activity that's going on. And so there, the primary thing I'm advising sort of CEOs is, put a time, like if you're normal, so for example, in one of the companies, which would normally have 9-month sales cycles, they are now closing deals in 2 to 4 weeks. Cuventus is one of those examples of a company where they have the potential to do that. And so there the question then really ends up being, okay, if you can close deals fast enough, then your forecast holds. If you can't, then you have to sort of really do a worst case scenario, maybe assume half the revenue or less, and then sort of redo your expense plan. So that's the summary.
Excellent. Thank you, Ursheet. I want to bring in Desiree Ho. So Desiree, if you want to turn on your video and ask your question, and we'll come to Natalie Ma in a second. But Matt, if you could just take that question quickly, and then Jenny, and then we'll go on to a couple more questions before we have to wrap up on this segment of SynBioBeta Live.
Okay, I'll make this quick. Hi, I'm Desiree.
Sorry, Desiree, just hold on a second. We're just going to go to Matt and Jenny, and then we'll come to Natalie, and then you. Sorry, go ahead, Matt.
No, I defer my slot to Jenny, since we're running short on time.
Okay. Well, Desiree, why don't we take your question, and then Jenny, you can answer both of them. Go ahead,
Sure.
Desiree.
So really quick, like, do you think there will be a shift in mindset during this pandemic when people think of biology as something that might be a solution to something that is as disastrous as this, or do you think people will become more fearful?
Good question, Jenny.
Awesome question. So in the previous question, I'll just add to Ursheet's excellent framework an overlay of what I think is a sense of creativity in this space. So back to Kevin's question, to John's question, which is, I think companies and their investors are looking for more creative ways to, as Ursheet was describing, extend that runway, find those additional revenues. And so that means there's really an opportunity to focus on building very strong partnerships, and in particular, recognizing where John's question is coming from with strategics, where maybe the company might not have been focused on building those great strategic relationships, whether it's to Bayer or to Codexis, but an appetite for doing that sooner, and for investigating co-development opportunities, other ways to advance the company's solutions development in a changed world. So that's a previous question. And then to Desiree's question, I think it's such an interesting one about what is the mindset change for the world as we think about biology. I think it's net positive. So as one of the few investors in the world who has a long-term interest in investing in diagnostics, suddenly everyone knows what diagnostics are and why they're important. So that's pretty helpful. That's going to be great for innovation. That's going to be great for investment, for government funding, that variety of flavor of capital we were talking about. So I think it's quite exciting. It does mean, I noticed another question, that we will have probably an influx of people who want to get involved, who want to contribute, who want to invest, and may not have that expertise. And so there will be a learning period and a winnowing out period as though those players figure themselves out. But overall, I think it's very much net positive. And we now, I think, are globally motivated to understand that biology is at the center of who we are and what we do. And it's at the center of many problems, but also if you just look at the expectations around COVID resolution, here in California, Gavin Newsom has laid out a path for lessening lockdown, and all of the pieces in that plan are biology based. We have to have robust and wide testing. We have to have therapeutic interventions that modulate or mediate the severity of disease. So biology is scary. It is complex. It's out to get us, and it is the source of many of our greatest innovations and solutions. So I think net positive.
Love it. Natalie, go ahead, ask your question. And if you just introduce yourself as well.
Yeah, of course. I'm Natalie Ma. I am a Blavatnik Fellow at Yale University, and will be joining Felix Biotechnology as Director of Business Development. We develop phage therapies for urgent microbial infections as well as other applications. My question is around the strategic pivot to COVID-19. So more broadly, I'm interested in thinking strategically around biosecurity as a biosecurity fellow through Johns Hopkins Center for Health Security. And I think I have two questions here. The first of which is, how are we being cognizant about our actions and investments as a group, so that what we learn from COVID-19 is applicable for adjacent applications, or how is that going into your investment decision-making process? And then at a higher level, how does the sort of strategic pivot itself help us learn more for the next strategic pivot we need to suddenly do when we have another threat that arises biologically?
John, if I might.
Yeah, go ahead, Matt.
So I answered some of this in the inbox. I have a very negative view to quote unquote pivots. I think the companies that are delivering value in the face of this pandemic are companies that have been thinking about diagnostics for a long time. My gently teasing cough to Jenny's comment was that both she and Ursheet and I are all overlapping or parallel investors in companies in the diagnostics space, which to Jenny's credit and everybody else that cares about this, those aren't popular, sexy companies. Those aren't 1 billion run rate fruit delivery or Chinese dockless bike companies. Although the piles of rusting bikes kind of tell that story there. I sincerely believe that the courage to invest in these quote unquote unpopular but potentially incredibly high return, high utility sectors is something that differentiates real VCs like my colleagues here from tourists. And Natalie, to make it very specific to what you're doing, I don't want you to pivot to COVID. The coming anti-antibiotic or antibiotic resistance bacterial plague, which is already on our doorstep, is already being picked up in hospitals across the world, is as big, if not bigger by an order of magnitude, a threat as COVID-19. Alzheimer's is this rolling, crushing tax on our society. It steals our loved ones and people with intellectual and societal value away from us when they still have a lot to teach. We should be doubling down on Alzheimer's, even in the face of this pandemic and our anxieties about, trillions of dollars of market value fluctuating. We can't stop investing for the long term. And folks who are kind of performatively pivoting either to invest or changing their company's websites, at least for us, engender a very negative reaction. Did I answer your question?
Excellent. Yes,
thank
fantastic. Thank you, Matt. Thank you, Natalie. Great question. Jürg, I'd just like to pass to you for the final word here. Do you think companies should be pivoting to COVID-19 or staying the course on what they're focused on?
Yes. So clear answer to that. Of course, you should stay the course. Do what you're good at, what you have planned to do, right? And no short-termism. I totally agree with what Matt was saying. Having said that, I think what COVID will probably, the positive impact COVID will probably have on all of us is that it will make us aware again, that infectious diseases are still an important topic, right? I think we have forgotten a little bit about that. A lot of the investment dollars have went into oncology and Alzheimer's, etc., and we have neglected infectious diseases. Antibiotics, as was said earlier. We have the resistance issues there to be overcome, and nobody's really investing in that at the appropriate scale anymore. Vaccines also, many people have abandoned the vaccines business. Diagnostics maybe also doesn't get all the money that it should. So I think it will sort of lead people to think harder again about these infectious diseases and what we ought to be doing about it. And the second positive effect I hope we will see after COVID is that more people will choose to go into biology. If you're a high school graduate, I think you will notice what how much things are still going on in biology and what a threat that can be to our life, but also how powerful a tool that can be to solve some of our biggest problems today. So that would be my closing remarks to this discussion.
Thank you. Thank you, Jürg Eckhardt at Leaps by Bayer in Switzerland, Jenny Rooke at Genoa Ventures here in San Francisco, Ursheet Parikh at Mayfield down in the South Bay here in the Bay Area, and Matt Ocko at DCVC, both in the South Bay and in San Francisco. Thank you all for sparing an hour of your time to talk investment with us. This has been a thrilling panel, and really appreciate you all coming and doing that. So thank you all.